Welcome back, everyone, to my stock market weekly update series, which I post every Saturday. In this week's episode, we will be finishing up the Q3 earnings season with a final result, and we'll also take a look at what's expected to come in future quarters to see just how long the highly anticipated 2023 recession will actually be. And we'll also cover a new inflation report that just came out, and as always, we'll finish up the video with the biggest gainers and losers for the week as well. So it's going to be a fun one. Hope you guys enjoy it. Let's go ahead and jump straight into it. All right, and starting first here with the markets, it was really just a bad week overall, with the S&P 500 seeing 4 days in the red, only one in the green, and it fell by over 3% for the week, while the tech-heavy NASDAQ followed it with even worse performance, seeing about a 4% drop, leaving now the S&P 500 down almost 20% from the top, while the NASDAQ continues to experience a massive crash of well over 30%. Turning over to market news though, the biggest update that we got this week was on our lingering inflation problems, as the producer price index was released, otherwise known as PPI, which is a measure of wholesale prices. It's basically what retailers will pay to the producers before they resell it to consumers, which would then be measured as the consumer price index, or the CPI. But we actually won't get CPI numbers until next week, so make sure you keep an eye on next Tuesday, because that'll likely move the market in a major way following that report. But for now, all we can really look at is the PPI here, and unfortunately it came in a little higher than expected for the month of November at a 0.3% gain month over month versus 0.2% expected. It also came in above 7% year over year, which of course is extremely high, and it's really horrendous for the economy. But on the bright side, it does at least show that inflation rates continue to fall from their highs. In fact, this is now the smallest increase that we've seen since May of last year. So the hope is that it continues to fall so that the Fed can eventually ease up on those interest rates. Speaking of which, Q3 earnings have pretty much wrapped up market-wide, with 99% of S&P 500 companies having already reported, and despite all the headwinds, over 70% of them actually reported better than expected results for both sales and profits, with total earnings rising by about 2.5% for the quarter. So it was actually a pretty good quarter considering really how bad the macroeconomy is. But unfortunately though, all the major investing outlets have started reporting now that the fourth quarter will almost certainly see a sizable decline in profits, with most companies having already guided down for Q4, setting up what looks to be a very rough end to the year, with FactSet expecting a negative 2.5% decline year over year. Now, why does this matter? Well, as you've all probably seen all over the news this year, a recession is highly anticipated in 2023, and it just so happens that analysts expect companies to report their weakest numbers for the year during the first half of it, which means that the recession will almost certainly take place somewhere between these next 6 months. However, that's also why I personally believe that the recession will be very short-lived, because according to FactSet, even with all of the recession fears, analysts are still projecting a sharp rise in company profits during the second half of next year, with Q3 seeing a rise of 6.4% and Q4 seeing a giant double-digit spike of over 10%. That's really big. It's only really the negative fourth quarter of this year, followed by tiny growth of about 1% or less that is expected in Q1 and Q2 of next year, that are the real problem. But as soon as we get past that, you'll likely see the economy start to recover, especially if inflation gets under control and the Fed can ease up on those interest rates, which, by the way, make no mistake about this, guys, when the Fed eases up on interest rates, you will see the market rip higher, because it practically always does that. And let me just pull up this chart for you guys here. Right now, stock prices are finally trading below profit levels for the S&P 500. So you've got the past 2 years where they were way higher because of all the reckless, stimulus and spending that we did. But now that the market has essentially crashed and come back down to reality, you've got prices that are finally trading at reasonable levels here. And I think next year it'll have the opportunity to jump up again as the economy improves and earnings start to go higher in the second half of the year, second half of next year. Of course, until then, things will likely remain extremely volatile in the stock market. But as a long-term investor, I actually really like this time period that we're in right now because we have stock prices finally coming down to reasonable levels, and you've got a lot of fear in the market because of an upcoming recession, which I think is not going to be a very long recession. So as a long-term investor, I get great prices for some of my favorite stocks that I do think will perform better over the long term. So, I'm feeling pretty good about where we're at in the market. Again, I don't really care about the short term. I care more about the long term. So, but that's just my opinion. Anyway, with that said, guys, let's finish up the video now by running through the biggest gainers and losers for the week. All right, and starting first here with the gainers, nothing too exciting this week as most of it was really just filled with volatile Chinese stocks, which we tend to see almost every week at this point because they're so volatile. One week they're up a huge amount, the next week they're down a huge amount. But anyway, this week we had some gainers here, including the gaming company Billy climbing almost 30%. There was Melco Resorts, who has a large resort and casino presence in Macau, climbing over 25%. There was a couple of Chinese airlines that also climbed by double-digit rates. And all of that, by the way, has to do with optimism that the country will ease up on those travel restrictions that have been so heavy lately. So if travel comes back, casinos, resorts, and airlines, travel business, all of that is obviously going to perform better if they do that. But that really is an issue that changes every week, so we'll have to just keep a close eye on it to see what really ends up happening. But on top of that, you also had Tencent Music climbing by 10%, and an online education company in China also rising by about the same amount. Really, the only stock that catches my attention, though, is I would probably say Mongo Database, ticker symbol MDB, who rose about 20%. And databases, of course, are used to organize and analyze data, typically in the form of like columns and rows. So think of like Excel sheets, kind of that type of organization and data analysis goes along with databases. But I remember using Mongo during my college years because they actually offer a free open source database that also adds additional functionality and upgrades to those legacy versions. And coupled with their premium versions that actually charge a fee, well, Mongo has actually seen a lot of success over the years, a lot of growth, with both their stock price and their sales skyrocketing by giant amounts. Unfortunately, though, their losses have also gotten worse over that time, now burning through hundreds of millions of dollars a year, which has caused the stock to crash by almost 70% because of the current market downturn. These type of companies that are unprofitable, they may have high growth, but they're unprofitable, yeah, they're not going to perform well during this type of market. They'll crash. And I personally would love to look deeper into this stock, but even after the crash, their valuation is still sky high. I mean, they've got a price to sales ratio above 10. That's after the crash. And that's like 350% more expensive than the sector. So I don't know. I think this week they climbed because of better than expected earnings, but at that valuation, I just can't really touch this stock. Moving on though to the biggest losers, and that's really the section that I usually like to look at more because stocks dropping, that kind of catches my attention a little bit more. But looking at the biggest losers, there wasn't really anything too exciting here either. I mean, you had Coinbase falling over 15%. That's obviously because of all the controversy surrounding FTX and the collapse of certain crypto exchanges and how much crypto prices have been crashing. So all of that is really weighing heavy on the crypto market. But I don't think I'm personally ready to make any moves in the crypto market yet. I'll probably just kind of be waiting for a little bit. But we also had Plug Power fall by 15%. That's a somewhat popular spec stock in the market of hydrogen fuel cell equipment. And there was also a couple of video game companies that fell by over 17% each in the video game software company Unity and the video game retailer GameStop. But I don't know. I don't think any of these really look too interesting to me. GameStop, by the way, I mean, that's a really crazy stock. They used to trade for only less than $1, before the meme stock craze really sent it soaring to 120, where it proceeded to crash by over 80% after that. And it was really a way of like fighting back against the giant hedge funds that were shorting it. And to this day, it still trades above $20 a share, which is pretty crazy. But none of that is really connected to the company's actual performance, because GameStop's business has been in heavy decline for years as they relied on an old business model that doesn't really work anymore. They used to be really big back when physical game sales were still popular. So they would buy used games from people and then they would resell them for a higher price. And that way, their business model worked. But now with the rise of digital games, it's just not really viable anymore. In fact, PlayStation already reports that nearly 80% of their game sales are digital. And going forward, you can see on this chart here that the trend has only really been getting worse for physical games versus digital. Personally, I hate that because I love having physical games in my collection, but it's just a sad reality that we live in now. Everyone's buying digital. And as such, GameStop has had to turn to selling toys, accessories, and collectibles in their stores that usually just end up getting put on clearance anyway. It's sad to say because I actually love shopping at GameStop stores, but I just think that in the end, only the big retailers like Target and Walmart and Best Buy will be left selling these type of items because they can afford the lower margins on them because of everything else they sell. So they can afford to almost subsidize that part of the business because of everything else that they sell in the stores. Whereas GameStop, either those things sell really well or it really damages their business. And I just don't think that that's a business model that is going to survive because it's not diversified well enough, in my opinion. But anyway, those are just my thoughts. I'd love to hear what you guys have to say down below. That's going to do it for this week's update. Hope you enjoyed it, and I will catch you in the next video. Take care, everyone. Bye-bye.